Mate, thank you very much for jumping on here. I know we've had some good conversations previously about how to pay yourself and also some of the common problems that we see. Let's clear the air today. Let's address what is PAYG, what are dividends, and we'll lay out an ideal framework of what best case scenario should be. Just tell us about yourself first before we jump straight into the details.
Financial Foreman, the trading's accountant. I've been running my business about for 8 years now, specialising with working with those in construction and trades. I feel like they need a bit of help and advice on tax and the finances side of things. So yeah, been doing that. Loving it.
Perfect. You've been helping out a lot of the guys that work with myself on the alpha trading side, mainly to, and correct me if I'm wrong here, but I was explaining this to my wife actually, that you can become a qualified accountant just like you can become a qualified plumber. But there's a range of people who can do a range of plumbing services, and there's a range of people that can do a range of accounting services, and they're not all created equal. And I think something that I'd really like to air early on is that not all accountants are created equal. And just because your accountant says it's the right thing to do doesn't necessarily mean it is, because your business operates different to everything else. So that's something that I really want to clear early. And that's something that we get along with really well, because we both want to see gross profit. We both want to see our cost of sales or cost of service. Both of us want to see operating expense margins, and both of us want to see healthy profits. Now, a lot of people will do any which way of the art of finance to pull out some metrics, but they're the key ones that we're looking for. And the reason we want to do that is today to establish how to pay ourselves properly, regardless of how big your company is. Now, there's a little buffer window as well, isn't there? Like the startup guys, just get moving. Just focus on getting moving. Once you've done a couple months, 3 months in, just start to tidy things up a little bit and then bring this framework in. So just get moving first. But for the majority of people that we'll be talking to and they'll be watching this, they're already doing, $500,000, $1 million a year. We want to get some really good foundations going. So best case scenario, PAYG. Let's start with PAYG. What is it?
I think it's probably best to take a step back and establishing, business structures. So a company is a separate legal entity to yourself. So when it comes to taking money from a company, it's either a loan or a wage. The loan is dividend approach, but essentially you're an employee. So you're receiving a regular salary from the company, and that's paid into your personal bank account, and you pay for all your personal living costs in there. And that's kind of a simple approach to doing business. Pay it into your account. You don't have to worry about paying personal expenses through the company and that sort of stuff. Pay it into your own account. Keeps bookkeeping nice and easy as well, reducing the number of transactions. And so you just receive a salary, whether that be 80 to you probably wouldn't want to go over 135,000, but that's the salary range you're kind of taking. And it's just regular, whether it's once a week, once a fortnight, it's just processed and paid into your account.
I know the answer to this, but a lot of people are probably following along like, why 135?
That's just a staggered tax rate. So obviously individuals have marginal tax rates. They've just changed recently. So 0 to 20, you pay no tax. 20 to 45, I think it's 18% now. And between 45 and 135 is 32% tax. Once you go over the 135, it's 39%, which starts to bite a little bit. So obviously you got the company, straight through a company, that's got a flat rate of 25%. No matter how much you earn, it pays tax at 25%.
So, and I know we're straying away a little bit on the topic of tax, but while we're talking on it, it would be a logical answer or a logical process to pay yourself the minimum amount you need to live comfortably for the work you're doing through PAYG, so that you're paying your tax as you go. You're doing your nominal super, and for all of these guys as well, we have some form of work on our work site, or whether we're traveling in the cars or anything like that, which work cover then will cover us for that being as an employee. But if the company's only paying 25% tax and we're going to be paying more than that, regardless of whether we're sub 135 or over 135, probably not getting to the 190 just yet.
Yep.
We would be better off using our company as a vehicle to pool our cash as opposed to drawing it down personally, wouldn't we?
Correct. Yeah.
Yeah, because of the vast difference in tax rates. That's the story probably for episode 2.
Yeah.
Or 2.0.
Yeah, that comes down to like a budgeting standpoint and personal finances and working backwards from there. It's like, what's the min you need to live off? And then working back from the wage and your net tax to kind of work out how much you need to pay. But yeah.
Exactly. Okay, now let's jump off the bridge and into some really murky river water. What happens if we don't go completely black and white on PAYG, pardon me, and we decide to play in the dividend area?
Okay, so yeah, simplicity from the start. If you're taking money from the company, that's a loan. So that is an amount you owe the company. Now, what will often happen is a dividend is paid at year end to clear off that amount. But the key proviso there is the company has needed to pay income tax first. So if you're starting out or you're relatively, you probably don't have enough income tax credits or franking credits to fully frank that dividend to clear it off, so you owe the company nothing. So what I see happen all the time is you'll pick up a file and there might be 200,000 to 300,000 in these loan accounts that the director owes the company.
And we would see these looking at, if you look at your balance sheet now, you'd see these as either your first name, full name, or, you and your partner's name loan, or you'd see them as owner A drawings if your bookkeeper's really lazy, because that's the generic zero term.
Yeah,
Or,
correct.
a whole range of those kind of owner loan to company, or your name or something of the sort loan to company.
Yeah, so you'll quite often, if they're on top of it, they'll be shown as like a non-current asset, but more often than not, they're just shown in the liability section as a negative liability.
And for those who like their research and want to dig a little further, we'd be calling this like a Div 7A loan, wouldn't we?
Correct.
As the correct name for it. But there's no real need for you guys to know the intricacies of that. We just want to know how the money moves and kind of how to structure things in a way where we're not accruing this liability onto our balance sheet into the future, because all we're doing is really kicking a bucket down the line. And something that's really stuck out to me, which is why I really want to address it, is at the moment we have a small income, we've got an income bracket that we're playing in. Now, if you start to accrue these dividends on this Div 7A loan on your balance sheet, eventually your income's going to go from bracket, I'm just calling it bracket 1, as in sub 135, where most people are, to kind of the next bracket. And your income, providing you keep getting better and better at business, should go higher and higher and higher. So you would be better off clearing some of these loans early on, and I'm not saying right away, but just early on, to be able to make way of having some of those franking credits because your company's paid some income tax, keeping it under the current bracket that you're in, and kind of just chipping away at it and staying on track with that. Now we've strayed away a little bit, but let's bring then, so doing one or the other is kind of a bit too exclusive. The ideal scenario really is a mixture of both, isn't it?
Correct. Yeah, so that's where we may pay like a flat salary. So we went through the first example. Let's just say we're paying you 90,000. That's enough for you to live off. That's comfortable.
You got $1 million of turnover, and the company's operating quite nicely. There's a few guys doing that kind of thing.
Yeah, and what will typically happen is, if you're set up structured from the right, a trust will own the shares in the company that sits underneath. So then you get a little bit more flexibility with your tax when you're wanting to take more money out. Let's say you're wanting to deposit or a nice holiday. You may be able to pay a lump sum dividend, 40, 50,000 to the trust. And what that allows you to do is then maybe distribute it to your spouse who may be on a lower tax bracket and save on tax that way. But that's kind of that's the scenario that I like to work with. We'll work in, okay, what's the minimum amount we need to pay you to live off comfortably? Leave anything else over that in the company, just pay a flat rate of 25%. And then when you're wanting to draw down or you need a little bit more money, pay that dividend to a trust and then get it get it out through a tax effective manner.
Perfect. I always like to talk with the guys as well about structuring your salary for compensation for the work you actually have to do. So if you were to think of, if you had to replace somebody to do your job, that's a pretty good indication of how much you should pay yourself. Particularly if you're working two people's jobs, then, you know, you might be up into the above the 135 bracket. Or, you know, if you're doing a couple $1 million, then you're going to be up there as well. You're going to be paid well for what you do. The kind of second component is that I like to run through, guys, is that your performance of the company is what you should be looking at as far as your dividend goes. So if your company performs, you effectively as the business owner should be on a pay per performance. And I like to think of it, most of the guys are in construction working for builders. So we've got those kind of peak periods throughout the year, Christmas namely being the most, and then in the financial year when things get tidied up. I like to think of having like a 2 dividend distribution period, or like twice annually. Obviously once in January, once all of the, or usually early Feb, once all accounts receivable from December are cleared, you have a really good snapshot of how the first 6 months of the financial year went, and then you can give yourself a pay per performance. And then the same thing end of financial year, you go July, meet with your accountant, do your tax planning and things that you need to do there leading up to June 30. Then afterwards, you usually have another meeting or kind of a debrief with your accountant about how the actual financial year closed. And then it's a good opportunity just to seek a little bit of extra advice and be like, okay, company profited 200K for end of financial year. I'm going to take 25% of that. Then the conversation goes, like we were saying a little bit earlier, about is there franking credits available to be able to take fully franked dividends, and those kind of components that we don't talk about a lot as business owners, but we do need the advice from the accountant to go essentially yay or nay.
And to go back to another point you were saying as well, is another reason for paying the salary for what the role you're doing is because then you're able to better track your margins. Because, like, let's say you're paying yourself under a market wage, then you need to remember when you're trying to run all your benchmarks that you should have a higher net profit margin here. So it's nice and simple.
Inflating your numbers, aren't you? It's a pissing contest at the pub.
So if you pay yourself a market salary for what you do, then you don't have to worry about all these little add backs. It's like, no, this is the margins that you're hitting, and are you on target or are you not?
Exactly. I wonder whether do we need to cover something about franking credits and that kind of structure? Because we've got kind of going into the phase 2 of it, but it could be interesting because we do need to know it. We need to have some understanding of it. Can you just elaborate a little bit? Now that we know the right structure for our income is going to be paid properly on PAYG, and by properly, I mean for the job you're doing, and not blowing that out of the water, then getting a couple distributions a year so you're not double dipping and getting in there and taking profits out, and making sure that you're not having to pay unnecessary amounts of tax on that income. Then there's this notion, or there's this rule in accounting and taxation of franking credits. Can we unpack that a little bit?
Okay, franking credits simply is you get a credit for tax the company has already paid at 25%. So that gets passed along with the dividend. Now, depending on where the individual tax rate of where it's passed to, you can either end up getting a refund or have to pay a top-up tax. So if you look at all the tax brackets, it depends on where it falls as to is the 25% going to be enough or less. But that's where you have the conversation with your accountant. If you're saying, you know, a $20,000 dividend, let's roughly work out where our tax brackets are. Will we have to pay tax on, you know, will there be a top-up tax involved in that? If there is, you may bump it up to 25. So then you can put the extra aside for tax, and then you've got the 20 that you want. So yeah, it is a complex rule, but it's avoiding double taxation because the company has already paid tax on that profit. So then when it's in the hand of the receiver of that dividend, they get a credit back for the company tax that's already
paid. Too often I hear and see, and particularly even back in the day when I used to sell cars, too often I hear the story of I've got to quickly go out and buy a car. We're kind of shooting ourselves in the foot, and we'll unpack this as to why. We're kind of shooting ourselves in the foot on franking credits there, aren't we? If we go out and fully depreciate a vehicle. Now, that can't be done anymore. We're not allowed to fully depreciate, but nonetheless, you'd still be able to get 20% of it in the current financial year. So let's just, because you see it a lot, let's unpack the notion of the accountant told me to buy a vehicle, and why would they have said that? And then what is really a more educated understanding or educated decision based around that?
So that's essentially to save on tax, 25% of what you, like, let's say, the instant asset write-off might come back in eventually, so we might as well cover it back. So let's just say they up it to 100,000 again. If your profit was 100,000, you're going to have to pay 25 grand in tax. If you go out and finance, a utility vehicle, so you're not subject to the motor vehicle cost limit of 100,000, so like a Ram, 100,000 deduction, you save 25,000 on tax. You haven't necessarily paid for it because it's finance, and you'll pay for it over the next financial, 5 financial years. But for that year, you've saved 25,000 in tax. There are other, issues to consider there in terms of cash flow for the next 5 years, because you've claimed depreciation on that in that first year. So for the next 4 or 5 years, you're paying for that, and it's not going to be showing up in the profit for those.
And because there was in this scenario, no company tax paid for the period, we haven't had the opportunity to earn any franking credits as well.
Correct.
So when it comes time to actually make some money, you're paying full tax anyway.
Yeah.
So to frame the purchase a vehicle quickly to save on tax is like a band-aid solution to a poorly thought out problem.
Yeah, I mean, I always like to take the approach that purchasing a vehicle is good, but like, why don't we look at things that make your business more efficient or make you more money? So that might be plant and equipment, it does the same thing. Like maybe you're looking at a jetter and a camera for your trailer. That's going to make you more money and make you more efficient. A lot better than buying a new vehicle.
Then upgrading the fleet. Exactly. Exactly.
Yeah.
And to the point of getting into our business, we come into our business to make financial abundance.
Yep.
And the advice around this kind of part, there's definitely a time and a place to upgrade your resources. But if we're not paying any tax for the period, we're not then accruing those franking credits for the purpose of then taking more income for ourselves in the future. So we don't have that credit to fall upon. So all we've done is just taken away what future credits would be there for the coming financial year.
Yeah. And probably something I should have covered off, there's a long delay to franking credits as well. So it's when they're paid. So if you look at 30 June 2024, let's say we had income tax to pay for that year, we're probably not paying that till the 15th of May 2025, which would be the first point that you may be able to take a dividend from those franking credits. So there is a long lead time between paying income tax and having the franking credits available.
And that's where then you would be putting your dividends, and regardless, you'd be putting your dividends onto a Div 7A for the short term. But that's where we would be utilizing that function, isn't it?
Yeah, correct.
Excellent. Okay. Some final piece. I think it's important to know that if we are paying tax, we are making money, as just a bit of a blanket statement. Now, cash flow comes into it as to how much you really do want to pay. And there's a range of games that you can play to avoid or delay. You can't get away, but you will avoid and delay.
I kind of think of it's not delay, it's defer. Like
defer,
you're just deferring it to the next year. Yeah.
Okay, so sum it up for me. Let's just use a quick case study. You've got $1 million company, so $1 million turnover or revenue or sales or trading income, whichever phrase you prefer to use. You've got a small team, let's say 3-4 guys. You're paying yourself 100K. The company is still profiting 100K as well. It's a pretty fair assumption to make. What is the ideal income breakup for that person? So that 100K, how do they take it?
So you may look at, once it's paid tax, like maybe a dividend of 15K, just to be around the 120, because the franking credits need to be added to the tax. But that's taxable. That's like a complicated scenario. But another the avenue I like to look at for clients is potentially salary sacrificing into super as well to save on tax. It's a way of building wealth while saving on tax. But so that's potentially what I would look at doing, is that salary of 100K, we've got that little bit extra there in terms of an amount we can pay out as a dividend if we're really wanting to, but we can also chip in some more money into super to start building a wealth balance there.
Perfect. Okay. Fantastic. So we've got it. We want to put ourselves on PAYG as low as we can to live the life that we require without being too wankerish. But just making sure that we're keeping money, keeping money in the company, because that's the lowest form of tax bracket that would be paid. And then paying ourselves like a performance or a commission based on the company's profits. And we might do that twice a year. And that would be a really smart way to structure our remuneration. And then obviously as the company grows, there's the discussions around, well, I'd like to bump my salary up. Then once you go to the next tax bracket, there's obviously a huge range between 135 and 190. And that's where you might start to have you might say to yourself, and with the accountant as well, you might fix it around the 150, somewhere like that. Seems to be a pretty good take-home income without paying too much super, without paying exorbitant amounts of work cover. But nonetheless, all those things are still in play. And then topping up the rest of your income, the other 30 or wherever that is, with dividends.
Yep.
Perfect. Thank you for your time, mate. Do you have anything that you wanted to sign off with?
No, I think it's important in business to keep it simple, and that's why I find paying a wage keeps things simple. You're not having to worry about income tax installments of various other individuals. It's nice and simple. You just receive a wage, you leave what's left over and sit in the company and decide what to do with that later.
Well, it makes household income budgeting very easy, doesn't it? Because you've
got
the regular amount coming in. You never get forgotten. You're always in the pay run.
Yeah.
It becomes a non-negotiable to pay yourself. So very good housekeeping. Awesome. Thank you for your time, mate. Appreciate it.
It's easy. Thanks, Sam.